Welcome, everyone, to the Information's TITV. My name is Akash Pasricha. It is Wednesday, February 4th. We have a big day of earnings to unpack. First up, I have an exclusive interview with Uber's incoming CFO, Balaji Krishnamurthy. The company announced he will be taking the top finance job later this month in its fourth quarter results. I'll talk to him about how he's thinking about the current and future state of the business. We'll also dig into AMD's results and the chip sector more broadly, with government regulation and M&A front and center. I'll be joined by Chris Miller, author of Chip War. We'll then break some exclusive reporting from the Information on a possible commercial deal in the works between OpenAI and Amazon. And finally, software stocks are tumbling left, right, and center. We will talk about what investors are reacting to with our finance editor. It's going to be a fun show, so let's get right on into things. Uber reported fourth quarter results. Revenue grew 20%, the same as last quarter and faster than each of the first two quarters of the year. But bookings growth is expected to decelerate in the current quarter. Of course, the big news of the day was that the company is getting a new CFO. Balaji Krishnamurthy is taking over that job on February 16th. But today, we have an exclusive interview with him to talk about how he's thinking about the current and future state of the business. Balaji, welcome to the show. It's great to have you here.
Thanks, Akash. Great to be
Congrats on the
good.
new job. You must be excited.
Thank you. It's been a busy day, but I'm happy we can do this.
Great. Well, I'm excited to get into all the different things that are going on with Uber's business. I want to start with the outlook that you guys gave for bookings growth. Now, bookings grew 22% in Q4. You're expecting it to grow anywhere between 17% and 21% in the current quarter. And that does incorporate a little bit of a tailwind from the foreign exchange rates. And so my read on it is that the bookings are expected to decelerate in the current quarter. Why is that?
So let me start with a clarification. The 17 to 21% growth rate that you refer to, it is constant currency. The FX tailwind would be incremental to that. We
Got
said we
got it.
expect at least 4 points of FX tailwind. So the reported growth rate would be 21 to 25%. That would be the way to think about that.
Okay.
But even from that, just stepping back, as you think about the outlook philosophy we've had, in Q3 and Q4, we guided to a similar 17 to 21% range. And for Q3, we delivered 21% growth. For Q4, we delivered 22% growth. And now our outlook is consistent. So I wouldn't read this as a big deceleration. If anything, in Q4, we got surprised a little bit positively because the holiday season was so strong. It exceeded our expectations. But otherwise, the underlying business momentum is exactly unchanged from the second half, and mobility and delivery both are firing on all cylinders, and we're very excited about the year.
I want to talk about mobility and delivery. I mean, these are two businesses that delivery is growing very quickly. Dara, the CEO of the company, has talked a little bit about the long-term ambitions for these two segments and the relative sizing of how they could play out. How do you see these two businesses 3 years from now in terms of relative sizing?
Oh, that's a great question. And that's a crystal ball gazing exercise that we have done many times and come out wrong. So I will not endeavor to go there. I'll say that both of these businesses are growing at scale, 100 billion, gross bookings run rate plus. Um, and they're both growing 20 plus percent, right? It's very rare to be sitting with those kind of global platforms, which can deliver that growth. So we'll make the appropriate investments in both of those businesses as long as the returns on those investments meet our hurdle rates, and then we'll see which one comes out on top. It's a friendly competition in
Friendly
some sense.
competition. Now, the other side of the business that, of course, the company is investing a lot into is your autonomous vehicles ambitions. And you talked a lot about that opportunity in the shareholder letter this quarter, and you talked about some of the misconceptions that you think exist around Uber and what the autonomous vehicles opportunity could mean for the company. What was the overall message that you were trying to send to investors with that?
Yeah, so that's great. So I would say, first of all, Uber is very, very bullish about autonomy. We think this is a technological disruption that is absolutely playing out. It's going to be a huge portion of mobility in urban cities in the coming years. And as we go through the next decade, it's going to become a big contributor to expansion of our TAM as well. And I think the simple reality that we think about here is that there's an opportunity to get to personal car displacement over the long run, and Uber's TAM then becomes $1 trillion plus if we can have autonomy unlock in the right way. It's going to be incremental. Now, what we see though is when investors think about autonomy and Uber's role to play here, there are a lot of misconceptions, and we've heard enough of them that we thought we would take a moment to just correct the record on a lot of these issues and put the nuance that's missing in the conversations that we hear. The first and most important one that we hear about is autonomy is going to be cannibalistic to ride hailing. That could not be further from the truth. Where we have autonomous deployments happening in Austin and Atlanta, our business is growing at the fastest rate in the US of any markets. Even in markets like SF, where we don't have autonomous on our network yet, we will by the end of this year with Nuro and Lucid. Even in a market like that, SF is growing for Uber faster than the rest of the large markets in the country, and it accelerated last year. And the underlying premise behind that is supply growth is always incremental for ride hailing demand. Another one that is commonly heard by us is Uber's profits are very concentrated in top 20 markets, and all you need to do is to launch in those top 20 markets to make a great business. And that is again very, very wrong, because as we think about our business, we operate in 8,000 plus markets in the US.
Hmm,
Consumers travel around the country, right?
right.
40% of people's trips happen outside of their home cities, and they expect this utility service to be available everywhere. So I think what that has done, and given our focus on driving that long tail of markets in our portfolio, 70% of our business now in the US comes from outside of those top 20 markets. 75% of our profits come from outside of those top 20 markets. And those markets are going to be unaddressable by AVs for a long time to come. I would
Let me
encourage everyone to read everything else we said. I wouldn't
right.
go into everything here though.
So let me go back to you talked about San Francisco as sort of a case study, and you talked about people thinking about the competition that comes from platforms like Waymo, and I know that Dara has talked a lot about this idea that look, you take something like a Starbucks. Starbucks has a direct consumer relationship. They also use Uber Eats to deliver food and stuff like that, and so there's sort of this hybrid system, but I do wanna get your read a little bit on, Tesla as sort of the wild card here. I mean, Waymo has set themselves up. Do you think that Tesla will, really come into the fold here as a do you think they'll pull it off is my question?
Sure. It's a good question. So I would start with the premise of camera only AV deployments, right? And today the jury's still out on that question, and Tesla is making a big bet that camera only, or vision only, can work on autonomy. So we'll see whether it works or not. We would never bet against Elon,
Right.
and we need to watch that.
But I mean, let's say
Yeah,
they put the sensors on. I mean, he has the model of the whole, you can rent your Tesla out, right? If you as part of the fleet model. So I mean, as a competitive threat, I mean, what do you think of it?
look, I think if they change their approach to this and moved in that direction, I think there is some time that they will take to make that adjustment. I would just come back to where they are today, which is based on their publicly reported data, their incident rate is effectively where Waymo's incident rates were in Q1 of 2023. So on that basis, it looks like they're about 3 years behind. And we are not saying that Tesla is not going to get there. It's entirely likely and possible that they would be there. But in that time, there are going to be other players who will also deliver autonomous, commercially deployable autonomous solutions, and we have the broadest set of partnerships, right? We have 20 partners. We are looking forward to bringing them to the 15 markets we've talked about this year, and that number is only going to go up in the coming years. And on our platform, the utilization and revenue generation capacity is going to be higher than anyone else's. So we'll compete on that.
Now, one of the interesting parts about Uber's strategy that you've talked about is the idea that in the near term, while the company has never been in the business of owning fleets and operating it and really sticking to this asset light model, you've talked about how in the near term with partnerships like with Lucid, I mean, you may own some amount of vehicles in the short term as you look to test out the economics of having autonomous vehicles. And I'm wondering, as the incoming CFO, the first question is how expensive is that? And what is sort of the upper bound of what you're willing to invest in owning those fleets? And how do you think about a return on investment on that over time?
Yeah. As you think about the context of our scale and what we are looking to build here, we have nearly 10 million human drivers around the world. When you think about the autonomous deployments today, the largest deployment, whether in the US or in China, is in the 3,000 vehicle range. What we will need for autonomy to really work at scale is tens of thousands or hundreds of thousands of cars deployed on Uber's network over the coming years. And to get there, the first step is for us to get OEMs excited about producing these vehicles, right? And they need to know that if they're producing these vehicles, they are going to be consumed by somebody. And the first step for that is we are working with our OEM partners on offtake commitments. So we may go to a Lucid and say, build us cars. We will guarantee that at least 20,000 of the cars you're building over the coming years will be moving off of your assembly lines, and we'll ensure some of our partners buy those cars, right? But in the early years, we may buy some of those cars ourselves just because we want to learn what this model looks like. We want to demonstrate the economics of these models, and then our partners can get third party financing to deploy it at a much more massive scale. And then the last point on this topic, as you think through that, is again, we are so early in this deployment ramp that we want to be flexible and we want to think through what evolution these models take. And it behooves us to remain nimble, and we will do so with discipline. We are not looking to expose a lot of our balance sheet, but to some extent we can do that. And at our 15 billion trip scale, this is going to be pretty small.
Do you have a budget for buying these fleets?
I'm
And
not going to set a number there. I would still say that if you think through the capital allocation priorities we set out today, I would say we have the ability to do to make investments in our core business, to make investments in AVs, to potentially look at bolt-on acquisitions, and still buy back a ton of our own stock, which remains very, very cheap. And today, the highest return on investment for us is to buy our stock, right? So we will be able to do all of those things in parallel.
hmm. I want to come back to the core operations of the business today. I mean, recruiting drivers is one of the biggest success factors to having a network like Uber does. Even today in 2026, what is the biggest challenge for Uber in recruiting drivers and keeping that growth going?
Yeah, I think it is the fundamental motion that we need to have. We are a supply led business. As we bring on drivers, we have to make sure that we are doing so in a way where driver onboarding is streamlined. Drivers can come onto our platform with as little friction as possible. So there's a lot of tech investment we have had to make in improving that onboarding funnel. The second thing we have to ensure is their earnings are predictable and they remain high relative to their alternatives. And we have done a very good job of growing our top line, our profitability, while delivering really healthy outcomes to our driver partners. And then finally, I think there's incremental pain points that drivers have always surfaced up to us, such as they want to see trip transparency, which we addressed a few years ago on where they're going, how much they would earn. They want to be able to, there's a long list of things that our product team has to go through to ensure that we are meeting drivers' expectations, because this is a competitive labor market, and if we don't meet those expectations, they can go elsewhere.
Great. Well, Balaji, I want to thank you for coming on the show and
Thank
congrats on
you,
the new
Akash.
role again. That is Balaji Krishnamurthy, the incoming CFO for Uber here on TITV. AMD reported its quarterly results. Revenue grew 34% in the fourth quarter. The company is expecting top line to grow about 32% at the midpoint of its range this quarter. Growth, for the most part, has hovered around this ballpark for the past year. Meanwhile, the chip sector has never been more dynamic, with government regulations and M&A being front and center. I want to bring on someone who has gone deep on this sector. Chris Miller is the author of Chip War. Chris, welcome back to the show. It's great to have you here.
Thanks for having me.
So there's so much that I want to cover with you. We have the AMD news this morning. We, of course, have the H200s, the trade rules, the NVIDIA Grok deal. So we'll see how much of it we can get to. But I want to start with AMD here. I mean, shares are down today because of the earnings. But I am curious from you on what you think of their place in the broader chip story right now, and what you make of their competitive positioning.
I think that the challenge that AMD faces is that they're not only competing with NVIDIA, they're also competing with all of the ASIC projects that Meta and Microsoft and Google have in-house. And what we've seen, I think, over the last couple of months is these ASICs are, at least some of them, looking pretty good. Google's TPUs in particular getting a lot of traction, impressive on their specs. And so that is creating a much more crowded market that AMD has to compete in.
Now, the other thing that came up on the call was the trade dynamics with China right now. And AMD is, like NVIDIA, waiting for all sorts of green lights from multiple different parties on getting its chips to customers in China. What do you make of the current state of that dynamic right now? We had some reporting in the last 24 hours from the FT that we're sort of back to a bit of a stalemate here between US and China, even though the US has given a green light. It's more of, strategy as opposed to execution right now. And then of course you have China that's waiting to see, whether the customers there will get their green light. What do you make of this?
Yeah, I mean, I think we know that the Chinese customers, ByteDance, Alibaba, and others, they want the chips, no doubt about that. They don't have access to domestic alternatives at the scale that they need. The Chinese government, though, is less certain. The Chinese government wants to make sure its companies have the computing resources that they need, but China also wants to build up its own domestic ecosystem to support Huawei and the other companies that are designing AI accelerators. And I think the Chinese government has been going back and forth on how many GPUs it's going to allow in, because it wants to make sure that there's plenty of space in the market for Huawei. In the long term, the strategy is to supplant foreign providers of GPUs with Huawei's own domestic production. And then the other uncertainty is indeed in Washington, where there's a debate ongoing as to whether and what volume of H200s should be sold to which customers. And so we've seen a formal green light from the White House, but that just kicked off a security review, which is currently working its way through the US government. I think one of the questions is, what are the customers that you can sell chips to without triggering any concerns about diversion to the Chinese government or Chinese military? And what are the customers that you need to be worried about? And that debate, as I understand, is still ongoing.
One of the questions that we try to get to the heart of on this show is you have the issue that will play out over the next few months, and this decision will go one way or another depending on what week we're talking about. But we're really, what I'm really interested in is the 2-3 year roadmap for how you think this issue plays out. Where do you think it goes on that time horizon?
Well, I think what we know with pretty high confidence over the next couple of years is that China's not going to have the domestic manufacturing capacity to produce the chips that it needs. Right now, best estimates are that the US plus Taiwan are going to produce something like 30 times the number of AI accelerators quality adjusted as China is. That's a huge gap, which means that for now, China's reliant on whatever imports it can either smuggle in or get its hands on legally. So I think Chinese tech companies are going to keep trying to buy whatever chips they're allowed to buy from the outside. And then the question is, on the Washington side, what are we going to be willing to sell or not sell? And I think here, you've seen the president signal a willingness to sell some, but you've also seen a strong reaction in Congress and elsewhere in Washington that is really cautious about giving China any additional computing resources on the grounds that the more chips China has, the stronger its AI models and the stronger its cloud computing firms are likely to be.
So basically, you're saying that even though this is a story that changes week by week, 3 years from now, you think we'll actually be in the same position where we still have US chips that are better and China trying to catch up, and we still have this dynamic.
Yeah, I mean, the key challenge that China faces is that TSMC is in Taiwan and China doesn't have anything comparable.
Right.
And so China can't currently make domestically the tools that you need to manufacture advanced chips, especially the lithography tools that ASML is the sole source of. It can't buy those tools because we don't let them. And so China's trying to make advanced chips using second-rate equipment, and it's very, very hard to scale up. They've been trying to scale up for a couple of years with some success, but TSMC is scaling up faster, building more fabs, racing forwards on its process technology. And that's how you get this 30-to-1 gap, which is really pretty extraordinary. And it's not something China's going to solve in a couple of years.
And one of the things I wanted to ask you, because you've studied the history of the chip sector so closely, is are there any historical parallels, maybe even outside of chips? I'm thinking about electric vehicles, for example. Are there any historical parallels where China has not had the capacity, the technology initially? Maybe they've come from behind in some ways. I mean, I'm just trying to sort of leave open the possibility that maybe there could be a breakthrough. I don't know.
Yeah. If you look at the sectors where China's done really well and kind of leapfrogged ahead, like EVs being a good example, what you find is that those are spheres where China's technology, you could debate whether a BYD is better or worse than a Tesla, but there's not a clear metric that says one is twice as good. China is certainly very competitive on price, and so if you match quality and are lower on price, you win the market. But in chips, it's different because you got this enormous quality improvement that drives an enormous quantity improvement in computing power. And so no one in the US is buying 4-year-old chips, to say nothing of 8-year-old chips, because they're just so much worse than the cutting edge that a company like NVIDIA can offer. And the need to stay on the cutting edge is just so much more acute in the chip industry, which means that you can't compete simply by getting 80% the quality and being half the price. You got to be 100% the quality to be in the game.
Now, you talked about TSMC, and I want to ask you about their work in the United States and their ambitions to expand here. That has been a long journey for them, and they've gone through a number of challenges. What do you make of the challenges they've had, and what it tells us about where they'll be 2, 3 years from now in the U.S.?
Yeah. I think TSMC is certainly committed to ramping up in the US. They've said publicly that they're going to have something like 25 or 30% of their advanced production in the US by the mid 2030s. That's a real big change from a couple of years ago when that number was zero. But it's also true that it's been a complicated journey. This is the first time TSMC's done advanced manufacturing outside of Taiwan. It's had to build up its local workforce, build up its knowledge, and it's confronted both a challenging environment, very different from Taiwan, that's driven higher costs. And so I think we should be optimistic that TSMC is going to build a lot more volume in Arizona, but we should be sober about the cost differentials that I think are going to persist over the long run.
What gives you optimism there?
Look, they've executed. They've already got one plant up and running. They've publicly said the yields, the share of chips they manufacture that work as intended are just as good, if not actually slightly better than in Taiwan. I mean, TSMC, I think, is second to none in terms of their ability to execute. And when they devote themselves to a project like this, I have no doubt they're going to fulfill it. I think the challenge for the US is just that it's not going to be at the same price point as Taiwan. And so we've got to balance our desire for resilience, which is important, with the cost dynamics.
Now, since the last time we had you on, the big chip deal that we saw was NVIDIA and Grok. And I wonder if you think that deal was offensive or defensive on NVIDIA's part.
I think maybe a bit of both. Certainly, the defensive dynamics are clear, but I think it was notable that just a couple weeks later, it was followed by an announcement of a deal between OpenAI and Cerebras, which is another firm that has inference-focused architectures, which speaks to the offensive part that these companies just need more capabilities that are more efficient at inference. And so, for NVIDIA, Grok could deliver some of that as well. And I think these two deals really open up a big new space for inference specific chips, which until recently haven't gotten a whole lot of market traction.
Well, and the third deal that to be clear, I mean, it hasn't it's been reported to be in the works, and there's rumors about it. We haven't seen any news of it formally, but the other deal that we've been watching is Intel perhaps looking at a company like SambaNova.
Yep.
And we have documented the fast growth of these chip startups here at the information for quite a few years now. I wonder if you think we are at a bit of an inflection point where you have these chip startups that are really coming to terms with reality with how big the competition is. And I mean, is this the start of, I don't want to call it the start of the end, but like we're seeing acquisitions. I mean, we've seen this play out time and time again in different industries.
Yeah, I think you see these acquisitions or these kind of interestingly structured deals, I guess, not fully
Right.
acquisitions.
Yeah. Whatever you want to call
What you're going to call them,
them.
yeah. We also see new startups in this space raising really substantial sums of money, and so I would say the venture space seems willing to keep funding new inference specific architectures, and so that either speaks to a realization that even if you get acquired at pretty large dollar amounts, or that the market is so vast that there's going to be space for both training specific and inference specific chips down the road. And so for now, it seems to me like investors are still willing to make a bet on there being a pathway for the inference specific chips.
Great. Well, Chris, I want to thank you for coming on. It was a great discussion as always. That is Chris Miller, the author of Chip War, here on TITV. Amazon is continuing to build its relationship with OpenAI. A new exclusive story from The Information Today reveals that there could be another deal in the works between the two companies, this one a commercial agreement. I want to bring on the two reporters who worked on that story. Anissa Gardezi is our cloud and compute reporter. Catherine Perloff covers Amazon. Welcome to you both. It's great to have you here.
Thanks, Akash. Hi.
Anissa, I want to start with you. Tell us a little bit about how Amazon is getting closer to OpenAI.
Right. So the two companies have been getting closer over the past couple months. Amazon talking about making a very large equity investment into OpenAI, and the companies also have an existing cloud agreement. But the new thing here is that the companies are now talking about a large commercial agreement in which Amazon would use OpenAI models to power Amazon's AI products. And so Amazon would become a customer of OpenAI, just like OpenAI is a customer of Amazon. And this is important because this would be if they go through with it, it would be a massive project for OpenAI to take on, and it might signal sort of where Amazon's AI is going.
Catherine, talk about that signal, about why that tells us about where Amazon's AI is going. We've talked about the Nova models. Is this just frustration again that they're not as good as they need to be?
A little bit. They Amazon wants to create a lot of AI products both in their shopping business, their cloud business, efforts to uh, be more competitive in enterprise software, and they want the best models for all of that. Amazon leadership has been a bit frustrated that so many of these products have relied on Anthropic's models, and the Nova models haven't been quite up to the task of powering those products all on their own. And adding to that frustration is the fact that Amazon employees can't, do that much more customization of Anthropic models than what a regular, Anthropic customer could, despite the fact that Amazon has invested billions earlier on in Anthropic. So they're looking for, a new partner to help power some of these ambitions.
Anissa, talk a little bit more about this customization here. Why is it so important for a company like Amazon?
Right. So this is extremely important for Amazon because of what Kathy just mentioned. They don't want to just get what everyone else can get off the shelf from OpenAI. They're not just, if they go through with this deal, they're not just going to be accessing the same API that any other customer could use. This would be a very deep integration between the two companies. OpenAI would devote a lot of people, and so would Amazon, to work on figuring out how can they, post-train, tweak the model after it's already trained so that it works in the Amazon environment. That is a much closer relationship than any other typical enterprise customer would have with a model provider. And so I think that just, shows how important it is. And we don't know how much Amazon would pay to use OpenAI models, but presumably this would be a pretty large contract for OpenAI.
And Catherine, explain to us you talked a little bit about the relationship with Anthropic that Amazon had. I wonder if this is sort of an acknowledgement that, hey, we just can't put all of our eggs into one basket, or if this is more frustration with what Anissa was saying earlier, which is that it's not doing the custom workloads that we need it to.
Yeah, I mean, I think it's a bit of both. I think the frustration is like, if Amazon products are based on Anthropic models, how different are they from what Anthropic itself is selling, and how different are they from what any other startup who is using, these models as a base for their products are selling? And Amazon wants to be differentiated in the market. There's been concern from Amazon leaders that their products like, Quick Suite, which is an enterprise search tool, or Kiro, which is a coding assistant, could just be perceived as like an Anthropic wrapper. So they want a little bit more of that special sauce. Their own models haven't been quite the answer. And also, Anthropic in general, for all of its customers, allows less customization than OpenAI does for its customers. OpenAI has like an API that allows for more fine tuning, and Anthropic allows for this, but not as robustly as OpenAI. So I think that, yeah, they're looking for something special, essentially. And if they can't get it from Anthropic, they're going to try to find another way. And if they can't get it from themselves either. So.
Anissa, last question for you. Put this story and this commercial deal into context for us in terms of the broader funding that OpenAI is trying to secure right now. And then also, I'm curious how the relative size of a deal like this, we don't know the exact numbers right now, but how does the size of a deal like this compare to the cloud deals that AWS clearly is I mean, I guess what I'm wondering is like, you know, are we talking about pennies here? Are we talking about, real proportions of revenue?
Yeah. So to your first question, this deal is happening in the context of the fundraising round that OpenAI is raising right now. They're trying to raise up to $100 billion. And we've reported that Amazon could potentially invest tens of billions into that round. So no doubt these two things are connected and getting worked out at the same time. I think one interesting thing to note is that we've also reported that Amazon initially was a little bit caught off guard by OpenAI and ChatGPT. So this is a very interesting place to end up, that they're now in talks for such a massive partnership. I think that's pretty interesting. And then to your other question, how does this compare to the cloud arrangement, and how big could the commercial deal be? OpenAI has a $38 billion cloud contract with Amazon over several years, and they could be, negotiating more cloud capacity as part of what we're talking about today. So I don't know if Amazon is paying back, OpenAI $38 billion. I would guess probably not, but I think we're probably talking about, something in the billions, and we'll definitely be on the lookout to figure out how big the commercial agreement could be. But there's definitely a lot of money circling the same companies here, as we report a lot here.
Right. Well, I'm just thinking about we just had the CFO of Uber on the call, and I mean, I think it's a great job to be the CFO of one of these companies, but I don't envy the bookkeepers who are trying to keep track of where all the billions are going. Because I mean, it's really just I pay you, you pay me back, and it's kind of like a Venmo balance, but just a big Venmo balance, albeit. So anyway, I want to thank you both for coming on. That is Anissa Gardezi, our cloud and compute reporter, and Catherine Perloff, our Amazon reporter here at The Information. A sell-off in software stocks is deepening on Wednesday. Shares of heavyweights like Salesforce, ServiceNow, and Workday, among others, remain under pressure as Wall Street goes wary of competition from new AI tools. Here to weigh in on it all is the Information's finance editor, Ken Brown. Ken, welcome back to the show. It's great to have you here.
Hi, Akash.
What really changed in this week in software? I mean, we look, software has been down for a while. I mean,
Mhm.
this has been a long-standing story. It feels like in the last 7 days, this story has really gotten worse.
Right. So, there's been a stream of news from the AI companies with, tools and products that could affect these software makers. And so there was some new stuff recently. Why it tips now? It's always hard to read the market. I mean, people just sort of felt like this was much more real. It had been building, and so inevitably there is always a moment where there's a general freak out, and we've kind of seen that.
So let's talk through a couple of the factors at play
Mhm,
here. One hypothesis that I've had is that we've had people on the show and I'm asking the question, do you think AI can replace software? And they
mhm,
pointed out, well, it can replace some software, but when you're dealing with an organization that is tens of thousands or hundreds of thousands of people, it's not like you can just vibe code a system that will be able to scale that big. And so that's a good point. I hear them on that. I do think though that one of again, this is a hypothesis, the software companies, I mean, they could be doing a much better job of telling investors
mhm.
this percent of our growth is coming from AI. They're kind of I don't know, they're hiding it right now. Maybe it's not even there.
Well, some companies have articulated it better than others. And but when a sell-off happens like this in a sector, it's no there's no differentiation, right? I mean, essentially, what's happened is software has been this steady earning, sector. You have long-term contracts, like you said, tens of thousands of people, and hard to remove, right? And the market was valuing these companies for that, and now the questions are: is that real, and is that going to be sustainable? And obviously, it's going to be sustainable for the next couple of years because AI is nowhere near doing what these companies do, but over the long term, which is what some of the value of these companies is, over the long term, yeah, it's a threat. And so people are just knocking down the valuations. These companies will be worth less in the market because there's a threat in the future. And so companies are worth more when people are confident in their future, and they're worth less when they're not. And then once these sell-offs happen, you don't want to sit around and watch it go down. You want to get out. And so everyone rushes to get out.
Right. The point you made to me earlier was you think of them or investors have thought of them as the safe sector
Right.
in technology.
Right, right. And anytime in any market, anytime where there's a perception of safety and that perception goes away, valuations go down because people pay a premium for safe returns, right? And so, that's why people buy treasuries, right? It's a safe thing. So in tech world or in basically all companies, this was seen as a safe bet because they're generating a lot of cash, they're big companies, they're embedded in their customers, it's hard to change. And so, that's what's happening.
The other story that I've been trying to think about in my head,
Mhm,
how it plays out is okay. So, in a world where OpenAI and Anthropic and other AI companies go public, these companies will come in at presumably much higher multiples than the
mhm.
the old school SaaS companies. And I wonder if this is a little bit of investors, I don't know, making room for those companies to come in and say, well, everyone can't be valued at, you know, 50, 60, 70 times revenue. And so there has to be some equilibrium there. I don't know.
Yeah, I mean, people are looking out at these IPOs, but that's too far out. I mean, this is a daily, weekly trading thing, right? Because nothing has really changed with any of these companies, right? And so what's changed is there's a threat to their futures, right? There's a threat to their future profitability, and so that's what people are reacting to. These big companies coming public, yeah. I mean, the other question with these big companies is like, how great is their business? I mean, they're going to be really speculative, and so yeah, you might want to ride that train and make a ton of money, but you also, especially if you're a professional investor, you need to balance your portfolio and you're going to balance it out with some safer tech, right? Tech is the biggest sector in the market. Everyone's got to be there, but you don't want to be in the most speculative stuff all the time, especially because all the big techs now, Microsoft, Google, Nvidia, are all deep, deep, deep in AI. And so if there's an AI hiccup, they're all going to get hit. And so, you would balance it out. So this is all going to play out, for the rest of the year and into the future. I think, the trick for these, I think you said it at the beginning, the trick for these software companies is to show that they're using AI. I think Figma did that really well in their IPO last year. Um, Adobe is now going to do a big ad campaign talking about how great their AI is and all that. But there are some companies that AI, it's kind of a
Right.
pretty big threat. I mean, I saw Intuit was down, and it's like, they do a lot of stuff, but like, can AI do your taxes? Yeah, I know. I'd be
Right.
pretty happy with that.
Well,
So.
and I guess this doesn't really help the point that I made at the start here, but then you do have companies like ServiceNow, which are coming out and being very
Mhm.
loud about the quantitative metrics that they're hitting with AI, and even they're getting sold off. So maybe now I'm going back on on what I said, and maybe that's not the reason for it. But the last thing I want to talk to you about, Ken, is so multiples are coming down, and who knows
Mhm.
how long they'll stay down. This, of course, could be a buying opportunity for
Mhm.
larger software companies, or in some cases, private equity firms, I'm sure, are circling. That could be a big story in 2026, don't you think?
Totally. So people tend not to buy when there's volatility. So I would not. I'd say it's going to take a little bit of time. But private equity firms, they're stuffed with software companies. I mean, there's been a great trade for private equity buying these things, putting a lot of leverage on them because they have steady earnings, so you can borrow a lot, and it boosts your returns. It's a great business until it's not, and now it's not. And so they're going to be looking to do deals. I don't know if they'll be sellers or buyers. They can buy companies and merge them with their existing companies. All these guys, there's gonna be a lot of financial creativity coming when things settle down. So yeah, I bet there's a lot of spreadsheets, cranking up and getting going. The question is, are they using AI to do the analysis? That would be,
Yeah.
that would be interesting.
And then I guess, on the flip side, as you said, buying and selling, the thing that I've been thinking about is, sure, it's a great time to buy, but for a PE firm that is looking for an exit, I
Yeah.
mean, we see, look, time and time again, I mean, they have to find a way to get rid of these assets in some places. And so what may have been the big software IPO 3, 4 years ago, I mean, if that doesn't exist at the multiple that they bought it, then I don't know. Then they gotta look to other PE firms to find, a multiple that attracts. I mean, overall, it's actually tougher.
It's they're in a tough position. I mean, again, it was a great trade. They rode it, and then there was a change, and they kind of were a little slow to catching on to that. So yeah, they're kind of screwed. But and then regular investors, everyone's going to be looking for a bargain. I mean, some of these companies could be great deals. Not quite yet, but yeah, and that's going to lead to buying and selling. That's going to lead to mergers. That's going to lead to roll ups. Some private equity firm is going to say, okay, we're going to roll up a bunch of companies and create some financial services software giant or some
Yeah.
whatever software giant, and this is the opportunity to do that, and that's how we're going to ride it out, and you'll see it. Not soon because no one wants to jump in right now, but give it a few months and give a little stability, and then yeah, that's exactly what this is going to do.
Great. Well, Ken, I want to thank you for coming on. That is Ken Brown, our finance editor here at The Information. That does it for today's show. Before we go, I want to highlight a new feature for the information subscribers. You can now easily search any chart from our reporting in our new charts and data library. Just head to theinformation.com, click on the charts button in the top bar, and scroll down to the latest data, or you can also use the search function to find exactly what you're looking for. A reminder, we are on this stream Monday through Friday at 10 a.m. Pacific, 1 p.m. Eastern. I want to thank you all for tuning in. We really do appreciate your viewership. I'm already excited for our next show tomorrow. Have a great rest of your Wednesday. Bye-bye for now.